How's it going, everyone? Paul Briscoe here, back with another video after a rough week last week. I'm feeling so much better and I'm ready to do the video that I was prepping for last week but just couldn't because I was knackered. Thank you for everyone's words of support. It was very helpful in that time. I'm just left with a little bit of a cough and a sore throat now, so I'm isolating for a little bit. But I appreciate last week's video was so slow, so I'm going to get straight into it. This week I wanted to talk about tax. Specifically tax towards investments. Loads of you in the comments have been asking about tax, whether they should be using an ISA, what the tax is on dividends, what about stamp duty, all that sort of thing. So I just wanted to get it all in one video and explain everything just as simple as possible. If you're new to my channel, about a month and a half ago I opened a stocks and shares ISA and put it all in a platform called Hargreaves Lansdown. I very quickly realized I wasn't going to get on with them and I found a new platform called Trading 212. Since then I've been making mistake after mistake, and these videos are based around my research and how I've applied them to my new strategy. So this week is about tax, and these are the basic things you need to know just to get started. I want to talk about the two main types of accounts that you can hold with Trading 212. I'm not worried about the CFD accounts, that's nothing to me. Some of you guys are doing it. Fucking brave, brilliant, keep it going. But me, I'm just looking at the invest account and the ISA account. The invest account is your standard investment account. You can put an unlimited amount of money in there if you wanted to, but it doesn't have any extra special tax breaks. In the UK, in a standard investment account, you can be taxed on anything you sell over £12,000. So that means that if you have £15,000 in your account and you sell all of your stock in the account, you can be taxed on £3,000 of that. That can affect us as long-term investors because we want to be getting over that amount. So if you're thinking in the future when you might have, say, 20,000, 30,000, 100,000, that day when you want all that money back and you click that sell button, you could have thousands of pounds worth of tax just taken off you. You also pay tax on dividends. You do have an allowance of up to £2,000 of free dividends, but after £2,000 you're getting taxed 7.5%, I think it is. That's a tax as a dividend investor I could really do with avoiding. I must admit, getting £2,000 worth of dividends in 1 year seems quite far away for me, but the whole point is that one day I will start getting that. And if I'm starting my investment now, I really need to make my good decisions now because they will benefit me further in the future. The only thing you can do to make it a little bit easier is if you're married, you can actually use your partner's allowance, which brings it up to 24,000. But on the other hand, capital gains tax doesn't actually just mean stocks and shares. It actually means anything over a value of 6,000. I'm kind of making that up off the top of my head. I know it's around that amount. It's basically any object you own other than your car all comes under capital gains tax. So that's the invest account. It's pretty simple. You do still get quite a big break from the government. It's not that bad. But in the future, if you're thinking of selling, you could get really stung on tax. Say if you had 100 grand, you would be looking at... It doesn't matter. It's just if you're thinking long term and you're going to have a lot of money at the end of that long term, you're going to get taxed a hell of a lot. That's where the stocks and shares ISA accounts come in. Stocks and shares ISA accounts are unlimited on their tax. You can't be taxed on anything other than stamp duty in your account. So all of your dividends are yours, all of your growth is yours. You can have it all back whenever you want it. That's pretty much the main and only pro of the stocks and shares ISA. You can only put in £20,000 a year into the one ISA account. I have mine in Hargreaves and Lansdown right now. I have already added to that this year, so I can't now add any more into the new Trading 2121. 2121. That's really frustrating because we've just had a fucking market crash and I could really do with cost averaging right now. But the benefit to this is you can add £20,000 this year and then you can add another £20,000 to a new account next year and another one after that until forever. That is why it's my choice at the moment. I don't even have a pension right now because I'm still trying to work out if pensions are worth it. That is another subject for a totally different day. Once you sell after all those compounding dividends and all that growth over all those years, you are not taxed on it at all. So that 20 grand could be worth 40 grand in 30 years and you won't be taxed at all on that money. There are other types of ISAs. So there's the general cash ISA, which offers you a small percentage of growth based on how much money you've got in there. You've got your junior ISAs for your kids, which you can invest in stocks and shares for them. They work in very similar ways. And you've also got another one, which some of you might be interested in, which is the lifetime ISA. The lifetime ISA works in a very similar way. You can have it as a cash or a stocks and shares ISA, or both, I think. It's very versatile like that. Again, there's no tax paid on anything, but you can only actually put in £4,000 per year. For that £4,000, the government will give you an extra 20% of that per year. But the sneaky government have put a lot of caveats in place to stop you from treating it like a normal ISA account. They're really trying to get you to start your own sort of pension pot or something like that. I think that's what the aim is. There are only 3 reasons you can take money away from it without a charge. It's if you're over 60, if you're buying your very first house, or if you have a terminal illness with less than 12 months to live. If you take money out for any other reason, they will charge you 25%. So that would mean that not only do they take away their 20% contribution to your transaction, they also take away an extra 5% of the money that you have actually paid in there. But the positives are still there. Everything's tax-free and they give you free money every year. The cons are a little bit weird though. You can't take any money out until you're 60, and also you can't pay anything in after the age of 50. So personally, I don't see the LISAs as really very helpful for anyone who's over 30. You're going to lose 10 years of cost averaging time. There's going to be 10 years where your LISA just has to sit there doing nothing. You can't have the money, you can't add to it, it's just going to slowly grow in interest. But if you're young and in your 20s, you have 2 very good options with the lifetime ISA. Firstly, there's a ton of free money there right up for grabs for you. You've also got an early get out clause in the form of a purchase that you are probably going to make quite soon in your life. You can have access to that money with your first house. So you'll be looking at a deposit in a really good investment for your future. It just depends what you want to be investing for. You either want to be investing for the even further distant future where you can achieve financial freedom and all that shit, or you can save up for something tangible like your house. I don't know what we're going to be living like in 20 years. With the current state of events, we could be living in tents fighting over the last potato or something. The lifetime ISA is not for me. Anything that purposely stops me from making my own decision in taking my money out just tells me that someone on the other end is benefiting more than they should be. But that's me, I'm just a bit pessimistic when it comes to this stuff. Finally, I want to cover a couple of notable taxes that you'll come across in your investment time. First of all is stamp duty. I have no idea what stamp duty is. I don't want to know. I just know I have to pay it. And you will pay it on every single share that you buy in every single type of account. That's taxed at 0.5% of every transaction you make. I do believe there is one type of fund that you can get away with it on. Open-ended investment companies, I think, get away with stamp duty for some reason, but it doesn't affect me anymore because while I have money in those right now, I'm trying to get out of them. And I don't think they're going to be part of my future strategy either. So personally, I'm not really that bothered. I'm just adding that out there for you in this video. Next is your tax on dividends. So as we spoke about earlier, you can get a tax relief in your investment account of £2,000 for dividends. In your ISA, you don't pay any tax on dividends, except for dividend withholding tax. Dividend withholding tax is a tax that some countries put on their dividends before they go out abroad. The most famous is the US dividend withholding tax. They tax your dividends 30% before they leave the country, officially. However, Trading 212 fills out a small form for you which reduces it to 15%. Seems ridiculous. I think it might have something to do with other countries having different treaty rules, so they are treated to a different type of tax or a different level of tax. And the UK's and I think Canada's comes down to 15%. That's a stupidly complicated way for me to say you will get taxed 15% on all your dividends from the US. I hope that's simple enough to understand. I feel like I've just made dividend tax a little bit more complicated than it should be. But to recap, stamp duty, 0.5% on pretty much everything. And dividends are taxed at a normal tax rate unless you're in an ISA. And the US charges 15% on their dividends as well. I think that might be everything that's really relevant to what my channel talks about. There are other types of taxes out there. There's a lot of different types of investments out there. But for this channel right here, the strategy I'm going to be using and the platforms I'm going to be using, that's really all I need to worry about. And to answer some further questions, the way you declare it is all through a self-assessment tax form, which is pretty easy to fill out online. Okay, that didn't take very long. I feel like I've covered everything. Feels like it should have taken longer really, but I think the truth is once you keep it really simple, this whole investment game, this whole financial game is actually kind of simple. Tax really is the scariest bit. It was the scariest bit for me, but keeping my money in an ISA will probably mean I don't ever have to declare it. I do hope this has cleared up a lot of the questions that people have been leaving in the comments. I'll do my best to answer any more questions that I can. If you're new to investing and looking for an account to open, you can use my link in the description below. If you use that to sign up to Trading 212, we both get a free share. And as ever, if you found this video entertaining and useful, please like, subscribe and invest.